This is fun. I should change the focus of my channel. Instead of talking about individual stocks, I should just talk about the macro. Turn on the camera, talk about the things that everybody else is talking about on Twitter, pretend like I know what I'm talking about, and then I'll get a lot of views. So the views have been pretty nice over the last few videos. And you see, meet Kevin. He's pretty smart. You see, look at it. He knows exactly what kind of videos to make. Now he knows that when people are talking boom and gloom, doom, he knows people are going to listen to Peter Schiff. So what does he do? He interviews Peter Schiff. And every single video that he makes is about Silicon Valley, how things are going to collapse, how much we should all worry. And that works out very well. And then when the market is hot, talk about, nonsense stocks that will later go to zero, but by that time everybody will forget. Now we're talking about what's in the media. So I want to bring up two tweets that I found quite interesting. Nouriel Rubin here, given the SVB mess, the FOMC cannot hike 500 basis points at its next meeting. Expect at most 25 basis points or even a pause to wait and see what happens in the financial markets. And then another tweet here, Richardson Whalen. They don't understand QE. Three quarters of all mortgages and probably half of all bonds are 400 basis points underwater. So I tend to, not that it matters, but I tend to agree with this here, that the Fed is meeting next week, okay? And I was reading the news before that they were going to hike as much as 50 basis points. They were for sure going to hike 25 basis points, but maybe they were going to hike 50 basis points. Now, people are talking about how they're not going to hike 50 basis points. They might not even hike 25 basis points. They might not hike at all, right? And this is what I was saying in my other video. So some of you guys said, why are mortgage-backed securities or government bonds negatively impacted when the interest rates go up? Well, it all has to do with discounting, right? Discounting mechanism. So think about this. $1,000 today is worth $1,000 today, right? $1,000 next year, it's not worth $1,000 because you don't get it today. So if you're going to get $1,000 next year, you have to discount it to presence in order to figure out what it's worth. So let's say if you are using, and I'm just throwing out a number, 10% discount rate, because this is what you expect to make on your money. So $1,000 next year, you divided it by 1.1. That's about $909. So $1,000 next year is not worth $1,000. It is worth $909 today. And when you have a bond or mortgage-backed security, they have those payments already laid out for the future. So if you own a mortgage-backed security, you know that next month you're going to get this amount, next month you're going to get this amount. It's the same, right? Same amount. So next year, so overall next year you're going to get this much. The following year you're going to get this much. You have all these payments going all the way into the future, depending on the duration of the instrument And you have to take all of those individual payments and you have to bring them to today, and that is the value of the bond, right? And so if now we go back to the same example of $1,000 next year, and instead of using a 10% discount rate, which is what we use to get 909 value for that one payment only, let's say now we have to use 15%, not 10%. So we have $1,000 divided by 1.15. Now we get 869. So 869 is less than 909, right? So when interest rates go up and now you have to use a higher discount rate in order to bring those future payments to today, they are worth less because you are discounting them by higher rate, okay? And now, so remember, 10% it was 909, 15% it was 869, right? So I'm gonna write it down. And I know for many of you this is basic, but if you are wondering why, that's why. Now, let's talk about duration, because if your instrument is 30 years into the future, so in other words, the payments are 30 years, the movement in interest rate creates a bigger impact on the value or whatever the present value is. So now let's say if that $1,000 originally that was from year one to now became 909. Now let's say that you're not going to get that $1,000 in a year from now, but you're going to get it in 3 years. So the duration is higher. So now you have to take $1,000 divided by 1.1. So you take it from year 3 to year 2. It's worth 909. Then you have to go again, discounted by 10%, to go from year 2 to year 1. That's 826. And then you have to do it again because it's 3 years, divided by 1.1 again. And that brings it to 751. So in other words, if you increase the duration, the value of that $1,000 in 3 years is not 909, how it was if it was just 1 year, now is 751. So the loss in comparison to the $1,000 is bigger on a longer duration, okay? So that's why a bank like as a Silicon Valley Bank, when they loaded up on long-term duration securities that carried low interest rates, low coupon, and then the Fed raised interest rates, those securities were impacted significantly because of the duration and because of such a fast movement in interest rates, right? So now, it's kind of like what the Fed is doing is you have kind of like in a war, you have people moving, right? People moving, and then there's people on the other side that are shooting bullets, right? And then they're shooting bullets, but none of the bullets are killing anybody. And then they move closer, and eventually some of the bullets start killing. And that's what happened. Silicon Valley Bank was the bullets started to hit. So now, if the Fed is going to continue raising interest rates, and I'm not saying this is right or wrong, if they're going to continue increasing interest rates, they're going to keep hitting more bullets and creating more losses in those securities that were originated during the time when the interest rates were historically low. And this is what this guy is saying here. They don't understand QE. 3/4 of all mortgages and probably half of all bonds are 400 basis points underwater. I don't know if this is true, but what he's saying is that most of the mortgages, that were originated, they're already underwater. And as they keep raising interest rates higher and higher, higher, there's going to be more and more losses. And somebody is carrying those mortgages and those securities on their books and are, in pain because of those losses. There's no other way around it. You increase interest rates, you create losses on those instruments. So now, with what happened with these two banks that just failed, Signature Bank and Silicon Valley Bank, this might have been a wake-up call, if they're smart, that, hey, maybe we shouldn't be raising interest rates. And now that's a problematic decision, because if you don't raise interest rates and the inflation continues to run high, well, then you can't control the inflation. But they got themselves into a problem, because if you start messing with the economy by QE this, QE that, inflate this, tighten this, you constantly play with the economy, then you create those kinds of problems. Now, they got themselves into a situation where they cannot stop. And that's because of what they did, 15, 20 years ago, starting that QE. If they never started it and they let the free markets operate, they let the economies go through, expansions and recessions without screwing with it, then we wouldn't have this problem today. But they created the monster, and now the monster doesn't want to cooperate in a way that they hoped.